What's up, everybody? In this video, I'm gonna be breaking down pivot points and how you can add them today into your trading strategies and start making money. First off, pivot points, kind of like all these other trading indicators, are a guide that is used to assist you as the trader in making a decision on whether to enter a position long or short at a certain price point, and it also helps you add conviction to the trade. Now, like all indicators, you should always make sure there are other parts of your thesis the indicator aligns with to ensure greater success, such as daily patterns. Does the stock have a news catalyst? Do you like the stock? Are you familiar with the stock? Has there been a lot of Twitter mentions on the stock? All that stuff still needs to be taken into account. So, what are pivot points? The Investopedia definition states, the pivot point itself is simply the average of the intraday high and low and the closing price from the previous day. This will represent itself as a line on your chart that you are trading. And obviously that's great information to know, but how do you actually use it? Each pivot point represents something different. However, it is expected that when a stock reaches one of those points, significant volatility or price action should occur based on which point is being hit. So without further ado, let's dive into them. All right, so what you will notice when you use a pivot point is that you have 5 lines, one in the middle, 2 that are above, and 2 that are below. The middle line is actually the pivot point. Traders will use this level as an area to first determine trend. If a stock is trading above the pivot point, it tends to be more bullish, or longs are in control. If the stock is trading below the pivot point, it tends to be bearish, or shorts are in control. Now, obviously a stock can go above and below this line throughout the trading day, so it also shows when the price action is changing. It's not always gonna stay above, it's not always gonna stay below. Now, this is great, but what about the other lines? The 2 lines above the pivot point are resistance levels. You have resistance 1, the first line, and resistance 2, the second line. You might also see that they are indicated by R1 or R2. These points are used the same way you would use normal resistance on a chart. They represent high levels of selling pressure. If a stock rises to these levels, they could be stopped out or fail at resistance. What's important to note is regardless if it fails here or if it doesn't, significant price action should occur at this level. And depending on if you are long or short, you're gonna use these points, these levels, for different reasons. Obviously, there's gonna be more buying pressure than selling pressure if a stock can blow past these resistance points, but generally, they're used to make a safe trading thesis. Let's dive into an example. Let's say you want a long stock XYZ, and the pivot point is at $1. And let's say for this example, the first resistance line is at $1.50. And for the sake of this example, we'll say that the stock is trading at the open at around 90 cents. As the stock begins to cross the pivot point, maybe you decide to enter and you get a position at a $1.05 average. As a long trader, you can now risk the pivot point, which is at $1, and plan for the stock to go up to $1.50, which is the first resistance point, which means it would be hitting significant selling pressure. If the thesis works, remember it doesn't have to work, but if it works, you would be risking 5 cents to make 45 cents, or in this case, 5% to make 40%. This is almost 8 times risk reward, which honestly is not bad. If there is significant buying pressure, you could even sell half at that level and let the rest ride, hoping it hits the second resistance level, which would make your gains even more significant. As you can see, the points allowed you as a trader to quickly develop a solid plan with defined risk reward. That is the beauty. You get fast risk reward trade entries without having to do a lot of guesswork. Keep in mind, this can also work in the opposite way. Let's say you're a short seller and you think stock XYZ should not be making these gains, and you see the same scenario take place. Well, in this scenario, you can use that first resistance line as your entry point. You could short sell in at 1.5 with the idea that it would meet heavy selling pressure and fade back near the pivot point at $1. This would essentially be the exact same risk reward trade, just in the opposite direction. This is the amazing thing about using pivot points as entry and exit points, is that you can actually calculate your risk. So if I'm a short seller and I'm very convicted and I think this stock should absolutely be going down no matter what, I could also decide to risk that second resistance point. I don't have to just set my risk at the first one. So if we use the same example, I would enter at 1.5, the first resistance point, but I would calculate the percentage between resistance 1 and resistance 2. So let's just say for this example, resistance 2 is at $2, which would be a 50% move from resistance 1. If I only want to risk $50 per trade, then on this example, I know I need to short sell only $100 worth of shares at that 1.5 level, because I'd be risking that resistance level number 2, which would be at $2. And because the difference between resistance 1 and resistance 2 is a 50% move, 50% of $100 would be $50. So therefore, I know I need to do $100 at my resistance 1 entry if I'm going to risk up to resistance 2. Trading in this manner allows you to always have a defined risk reward, and when executed correctly, can not only protect yourself, but also allow you to capitalize on very significant gains. Now that we covered resistance 1 and 2, let's go over the bottom two lines, which are support 1 and support 2, or you might see them annotated as S1 and S2. These behave the exact same way as resistance 1 and resistance 2. The difference is, at these levels, traders can expect more buying pressure than selling pressure. These levels can be great for longs who are trying to dip buy a stock, or by short sellers who might have entered a stock that's failing below the pivot point and are calculating how much range they can expect before the stock goes down before bouncing. The important thing to reiterate here is you should never ever use these indicators alone. Always use them in conjunction with a larger trade thesis to optimize success. I personally use them in conjunction with moving averages, VWAP, daily chart patterns, just to give me more conviction on if the trade is going to work or not. Let's dive into some real life examples and see how stocks react at these pivot points. So for this example, I'm going to be using the SPY just because it's a very volatile index and a lot of traders use pivot points here. And I just want to go over how it reacts at these points. If you play options on SPY, using pivot points to trade them can mean a lot of serious money. So let's dive in and show you what happens here. This was last week's trading, and let's dive into this day first. I'm just going to zoom in a little bit. If we come back to this day here, what we'll notice is these are the pivot points, okay? So this pink line is the pivot point. The two red lines above the pink line are the resistance 1 and resistance 2 levels, and then the two green lines below is the support 1 and support 2. What we'll see here on this day is the stock dumped down, and you'll see it started failing at the first pivot point. Now, what I like to do as a trader, I always like to see how it reacts over a little bit of a time frame. I don't want to just enter right when I see it first breaking. I want to kind of get an idea of where the stock's going to go, because remember, these points aren't gospel. They can change. You know, the stock doesn't have to respect them 100% of the time. What you see here is it goes below the first pivot point, showing sellers are in control, bounces back up, showing buyers are in control, but then fails down again. And you see it's just kind of hovering around the pivot. Well, after that, you'll see it reclaims a second time, and this time it keeps going up. Now, the key thing here is to notice that as it breaks this pivot point, it comes all the way up and then fails right at the first resistance level. It touches it and comes right back down. What you could have done is bought that secondary break here on the pivot point and then sold it up into this resistance level. Now let's go to the next day. Now this one is even more clear. Look how it opened. Comes up, it comes down, then it ramps right up and hits the first resistance level, and it completely failed. Now, as you'll see, it doesn't quite reach the pivot point. This is a key thing that you need to understand when trading these type of indicators, is that you want to use it as a range, right? It doesn't have to go all the way down. So you always want to kind of give yourself a little bit of wiggle room, maybe give yourself 1 to 2% above or below where you would sell. Because if you bought puts right here, you would have made a lot of money buying right here at that resistance line, expecting it to go down to the pivot line. You'll notice it respects that trend pretty well. So failed perfectly on the first resistance line, comes all the way down, bounces pretty close to the first pivot line, and then goes sideways all day. This day's a little same thing. Look, opens up, stays right at the resistance line, can't break past it, comes down to the pivot line, breaks below it. Now look at this, breaks below the pivot line, but starts bouncing right at the first support line, where there's a lot of buying pressure. Selling pressure on resistance, buying pressure at near support. Look how well it respects these levels. Starts basing, comes back to the pivot line. Now, of course, when it comes to the pivot line, this is where we have to sit back and assess, see where the stock is going to go, and it fails again. And then it has a huge wash right at the first support line. So now if I'm a short seller, let's say I'm playing puts, I'm going to be very convicted here because it failed the support, right? That's where a lot of buying should be. And if you look here, look, it bounces at second support. So here's the second level you can expect it to bounce at. Then of course it bounces, goes right near the first support and fails again, and it ends up actually closing below the second support level. But what's really important about this day especially is look how well defined your trade thesis could be. You could have started a short here on the first resistance level, risking the pivot point, right? Because if obviously it went above this, then it would, probably go to the second resistance line, but it doesn't, it fails. Then you could basically take some profits at the first pivot line, which would still be very significant. Or if you're more, bullish on the fact that it's going to go down, you could have sold into the first support line, which again would have been a great sell spot. On the SPY, this could be anywhere from 50 to 60% returns. And then as it comes back up, maybe you sell down here. Once it fails at the pivot point again, this is another entry spot for puts. And then look, as it comes down to the support line, you could sell some here. But once you see it just blow past support, now you can be even more convicted knowing, okay, wow, this is actually pretty weak. And once it bounces here, this is where I would honestly have taken profits, is on the second support line, because you have to also consider if there's gonna be a lot of buying pressure here near second support, what are the odds it keeps going lower? So you could have had 1, 2 very easy entries here, which would have made you a lot of money. Now, of course, if you're really convicted, if you have a lot of patience, you could have also entered here again as it fails above the first support level. And then again, knowing that it'll probably retest at least the second support level before bouncing again. And in this case, it actually failed. So you would have made even more money. And if you had swung it, look at this, it dumped even more. So this really helps with conviction building, with making a trade thesis that gives you essentially your entry and exits for you. You had multiple ways to trade this. Now, if you were really convicted, you could have put a buy order here on the first resistance line, risking this line. And as you'll see, it never came close to touching that. And you could have rode this all the way down, and this would have probably been a 400% winner if you bought right up here on that first resistance. Now, going to the last day over here, I'll try to zoom in a little bit. It comes down. This is the market open. It starts by support, can't reach the pivot point, and then you'll notice it kind of comes down and retests support again and keeps bouncing. When you see things start to fail, you want to try to trade them within that range. So like I was saying on the previous day, it's never a bad idea to be conservative, because what you could have done here is obviously get a put position into this fail and then sell into the support bounce, because look how cleanly it bounces off support, right? Then it comes back down, doesn't quite fail, and then it comes all the way back. In this scenario, it would have paid off to be more conservative, because obviously after the second fail here, it didn't fail all the way back down to the second support. It actually ended up recovering. So that's why, although it failed down here, for me, the way I like to trade, I always like to be more conservative and just take the easy entry and exit. On this particular chart, this one didn't have a whole lot of range, so the best trade would have been buying this support bounce and then selling it up here. Probably would have been a 20-30% winner. So not as much opportunity as back here, but if you just use these lines for simple entries and exits, you can really protect yourself and get some nice wins no matter what. Because even though this would have been hard to trade, I don't know if I would have taken any position here, buying as a dip buyer on the first support would not have been a bad trade at all. Now, obviously when it failed support here, I probably would not have bought here, if I'm being honest with you, because to me, this looks pretty weak. But again, it did actually recover and go higher, which again is another reason why you need to use these indicators more as a guide, not as gospel. Because if you went super heavy on a short right here and then it recovers, you could have lost quite a bit of money. So always be very cautious, use it as a guide, never go all in because of it. As you'll see here, pretty much every single day, it respects these levels very well. And that's why I love pivot points so much, because they allow you to just really get an edge that not a lot of people have. Definitely add this to your charts, practice it, use it, add it to multiple time frames, go to your favorite charts, go to Tesla, go to Apple, and just see how it reacts at these levels, and then start to implement that in your own trading. Alrighty guys, thank you so much for watching. I hope you learned something, and if you like this, please like, share, subscribe. If you want to join my private Discord and speak to me directly, you can follow the link below. You can also follow my Twitter, where I post all my trades every single day, down below as well. And of course, please leave a comment if you want to see me go over another topic. If you have questions, anything like that, just put it down below. I'll get back to you and help you as much as I can. All right, guys, thank you so much. Catch you on the flip. Peace.